Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media, my financial opinions as we go through it. It's generally related to three different topics: wealth building, commodities, and/or financial topics. So let's dive in. Let's take a look and see what people are sharing. If you want to follow me, it's at Funny_Finance. And if you want to join our community, finding-value.com, we've got a question and answer session that is going to be later today at 5 p.m. Mountain Time on Sunday. If you join, you can jump on the Zoom call. You can interact with me real time. And I'll also be going over portfolio position size, allocations, risk reward, particular setups and stuff, and give my opinions about that. It may differ from other people's opinions. It's not allocating X percent to this and Y percent to that. It's based off other things, is what I'll say. And I'll keep that for everyone who's part of the community. And I'll share my opinions pretty freely there with the individual companies and the setups that I see. So coming down, we got Squeaky Mouse. Squeaky Mouse says silver may just be the most bullish chart of all time. What he is showing there is, on non-logarithmic at least, is a cup and handle pattern and the potential breakout. When I do it, I put it on logarithmic. I get a breakout all the way to the $200 or $300 per ounce range, and we've already broken out of the handle. It's already broken out if you do it on logarithmic. Logarithmic, what that does is it sets it up on a percentage terms instead of the way it looks like this. So it's all based off percentages, and it squeezes the top portion together versus the small bottom portions. So if silver is the best setup that Squeaky Mouse has seen of all time, then what is platinum? Let's take a look at platinum here. This is me, as I said, platinum all sorts of squeezed up. So platinum priced in dollars, you can see that we are squeezing here. We have a very large consolidation all the way from the peak of 2008. One hump, two hump, three hump consolidation, the false breakout, and then we've come up and we've been squeezing the entire time here into this corner. The bigger the pattern, the higher the bigger the base, the higher in space. We've got a squeeze which is almost similar to the squeeze that's occurred here in the late to mid 90s. Right in here, this squeezing is occurring here. I think we could see a huge breakout for platinum at any time. I've been waiting for it. I've been accumulating on this white line here all the way back, even in 2020. Accumulation, accumulation, accumulation. I'd say anything around $900 platinum price, I've been accumulating and under. Now check this out. This is a cheap silver, and this is cheap platinum on the bottom. We have a falling wedge all the way to the corner at a ratio of 1 ounce platinum to 30 ounces of silver. Platinum is actually cheap to silver, and we've got a falling wedge, and a falling wedge generally breaks to the upside. So when I look at this and I look at how platinum is squeezing in dollars, we're getting higher lows coming right into this resistance line. This is about to break, and we're coming from levels that platinum is cheap to silver. So if silver launches here, what do you think platinum might do? And that's the big question. Does silver launch first and then platinum go behind it, where we even squeeze this down to a false breakdown? It's possible. No one's going to know that, but it's possible that it could do something like that. Or does silver and platinum run together and platinum actually outpace silver? I think that we could see platinum or silver run first and then platinum run shortly thereafter. That's my guess. and we're going through that right now. And that's completely based off the market conditions. So platinum is the cheapest metal of any commodity that's in the precious metal space. So platinum is cheaper than palladium, it's cheaper than rhodium, it's cheaper than silver, and it's cheaper than gold on a historical basis. It's actually very rare setups to be cheap against all the other metals. The last time that occurred, rhodium did that in 2016. Rhodium was the cheapest metal to all of them in 2016. It's just really hard to buy physical rhodium. Before that was palladium. Palladium in 2009 was at an absolute bottom. It was cheap against all the other metals. So right now, the opportunity, in my opinion, is actually in platinum, even though people are all bulled up on silver. And I'm not saying to buy exclusively one metal. I own a variety of metals, and I weight them appropriate to their cheapness. Moving down, breaking news. President-elect Donald Trump threatens 100% tariffs on BRICS countries if they undercut the US dollar. And it says, here we go. And we have seen some pretty strong selling pressure in some of those currencies where their currency exchange rate really went down the past few days, this past week. But is this the beginning of something that's bigger? I don't know. I don't know. Vancouver Island guy says WTI oil seasonal 20-year prior to the pandemic, taking out the post-pandemic rip where many of us made a lot of money. The average bounce starts first week of December with a large climb starting in February. Never the same, though sometimes it rhymes. Our first big large bounce generally occurs in the first week of December, and that's obviously coming up ahead of us. We'll see if that occurs, but the big moves generally occur starting in January all the way into the end of summer. Patrick says, yes, the fourth historical capital rotation event is still ahead of us. This is when commodities outperform for years. Completely agree, and I just wanted to keep this in everyone's thoughts. This is the big picture view. This is the way that I view the investment world. I view it like this. Like this chart is what I think will happen. It will play out this way. There's a lot of evidence in a variety of things. Let's just say the bottoming patterns of commodities. Those patterns link up with this ratio chart. It is supporting evidence of the herd lining up commodities for this to occur. This is 140 years of U.S. stocks priced in gold. And this is the S&P 500 divided by gold. So when this ratio falls, you're in a bull market for gold, and you're most likely going to be in a bear market for stocks, where the stock market moves sideways or lower over that period. It's occurred number one, number two, number three, and we are going to drop here any second for the fourth outperformance of gold over the S&P 500. No one is talking about this for the most part. Everyone is over there sniffing their own farts on crypto and staring at Michael Saylor as a god for leveraging up his company to buy as much Bitcoin at the top of what could potentially be the top of the market. He did the same thing back in the 2000s with his other company, and this is where it rolled over, right in that same time frame. These are considered market peaks. Generally, the market peaks for the S&P 500 and the NASDAQ. When this falls, what you generally see is gold outperforms. You generally see a commodity bull market. Energy generally does very well. And money in the system rotates differently. It starts to rotate towards commodities and precious metals. And with the setup that I see here going on, and the conditions that exist under this capital rotation event that they call it, that generally occurs under expansionary phases of real estate. And this was a big real estate boom with lots of inflation. This was another real estate boom here. And then we're going into, I think, another real estate boom. They're probably going to lower interest rates and move on up. But it doesn't have to be driven by real estate. It could also be driven by fiscal spending, which we also have a lot of. Interest expense can cause problems and cause inflation. And then any sort of, we'll say, restriction on the commodity side is going to blow commodities through the roof. I think a lot of restrictions are coming right ahead of us in the middle to late of 2020s, and that's everything, guys. You go through a whole bunch of different commodities that are going to be restricted. Energy, I think, will be restricted to some degree, specifically oil, um, copper, silver, gold, nickel, zinc, graphite, lithium, on and on and on and on and on. It doesn't even matter. They're all pretty rough. So we're right at the beginning here. What does this mean? Why is this such a big deal? Everyone is so worried about the short term. This is your big picture view. If this does fall, which I think is a high likelihood, then we're going to go into a completely different regime. Stocks and bonds do not work under that, under this type of condition. It's going to be commodities and it's going to be precious metals. So when I see this type of setup, you can be early. Like, for instance, if you had started to invest in, like, say, 1967, 68 here, which would have been the ultimate top, and you could see how it went sideways for a little bit. A lot of people would say, "Oh, it's not going to happen. It's false. It's a false move." No, it's not, guys. It's not a false move. It's going to work its way on out. So we've been going sideways for a little bit, but I do think this will eventually work its way lower. And when it does, I'll just say this: decades happen in years in terms of returns in commodities and precious metals. The 1970s, we saw gold go from $35 an ounce all the way to $850 an ounce. That is a huge return with very little risk. Silver went from $1 to $50 during that same time frame. We saw similar moves from the bottom of 2000 all the way to the peak of 2011, where this peaked out in 2011 here. And now we're going to break and do it again. So it's not about being perfect. It's not about making money the next week. It's about positioning for the big move. And when you size up the move properly, that is when you get huge returns. I know everyone is obsessed with crypto because of the movements in the markets. I understand it, but it doesn't mean that it's logical. The tough part here is technology generally doesn't do well when this falls. It's usually a tech bubble. When we look at technology, it is overpriced, and the retail sector is all over in crypto. Is crypto an extension of the technology bubble? In my opinion, it most likely is. And I don't know how it's going to respond to this move lower. And that's where I get reservations because you don't have the history. It was created in 2011 at the bottom of this market. It has lived in this gigantic bull market for technology, and it's only been through one market condition, which was a recovery phase of real estate. Low inflation, low interest rates, which is great for technology. We're about to find out what happens next over these next few years. That's how I view the markets here. Coming down to gold. Did you know during the 1970s, amidst high inflation and economic turmoil, silver peaked at nearly $50 an ounce in 1980? The Hunt brothers' cornering of the silver market drove the gold to silver ratio to 14 to 1. So back in the 70s, when we had this big move lower here, this is the 70s here, they tried to corner the market at the top of the gold and silver market. They tried to corner it at the top. Right now, we are at the top of a technology, Bitcoin crypto market, in my opinion. So what do you think I'm going to show next? There's a lot of confusion surrounding Michael Saylor's Bitcoin strategy. Allow me to explain exactly what's going on. This could be one of the best investments of your life. He's trying to corner the Bitcoin market. Hunt Brothers did it in silver in 1980 at the top of the market. Saylor's going to be doing this at the top of the market in 2024, 2025. That's my guess. And that's going to be for crypto. Isabella says, how do you find your gym motivation and healthy eating habits when you've lost them all? And what I'm going to say is this. This is me. What is your alternative? What is your alternative? To eat unhealthy and be unhealthy? So it's not about motivation. It's something that I have to do in order to have a sustained, healthy life. And health is number one in anything. Doesn't matter how much money you have. If you don't have good health, all the money in the world is not going to matter. It's not going to matter. So it's not a function of motivation. It's a function of living and wanting to live a life that is longer and more fulfilling and healthier. So I view it as a must do. Every single week, I work out 3 times a week and I walk as much as I possibly can. I try to walk every single day for the most part. I am a little bit of a pansy when it gets cold out, but that is that's what I do. So it's not about finding motivation. It's about the alternative. I am more scared of not doing it than doing it. And I've always been highly disciplined to just get through it and go. So it's not about finding motivation to be healthy. It's about self-respect, that I care so much about myself that I won't let myself get to a state that I would not be um, proud of, is what I'll say. Gold, silver, and S&P 500 since the bottom of gold in 1999. Silver will play catch up, in my opinion, here. So what I did is I put the beginning of the chart on the left, where my guy is over here at about 2000. So over here, I put them all at the same starting point at the beginning of what I think was a paradigm shift in the market. Gold is your green and red candlesticks, which is up here. Silver is um, the purple line, and the S&P 500 is the um, burgundy reddish line. So when you look at this, what I think is going to occur is gold's our leader. Gold hit it. We went into a recovery phase from 2011 all the way into the 2020s over here. Your recovery phase is your cup and handle. We've broken out of the cup and handle and are starting to move higher. So we've broken out of this recovery phase. That was the consolidation. On a much larger view, we also consolidated from 1980 all the way to 2011 and all the way to 2024. So that was one big consolidation. And you know what that consolidation was? Declining interest rates. So declining interest rates was the big consolidation all the way back to 1980 till 2020. It bottomed and broke out of that. We are in a different paradigm now. Silver is going to do a huge catch-up move. It'll outperform gold as we get going. The S&P is going to probably most likely lag at some point here. I'm not saying immediately, but it could lag here at some point, much like the 1970s and the early 2000s. Like this here, it went sideways. So that's what I think is coming ahead of us. And then these guys, since they've broken their big patterns and consolidations, are going to outperform. You're also going to see commodities rip. I mean, they're going to rip. Are we there at this exact moment? Maybe not yet. We could be in a slowdown-ish phase. S&P could go through its bubble top and do all that. But when it does come down, we could see everything get, sell off together depending on the rate of fall. And then commodities are going to rip. They are going to rip. Come down. We've got imagine your boss cutting your salary by 7% every year. That's how fiat works. So I actually did a calculation. Um, I used Excel. I looked at the money supply. The money supply has actually been growing by 6.5%, at least the data that is released on TradingView. So 7% is actually a pretty good number. And that's what's going on with your currency. And it's really hard to get real returns, real purchasing power returns, because if inflation is 7% a year, that means that the majority of returns of the stock market is actually inflation. It's not even a return. So you have to figure out ways to make money in the system that might not be a buy and hold strategy, the S&P 500. You have to be in it when it goes up, and you have to be in other asset classes when those other asset classes outperform, like when this comes down here. You want to be in stocks here. You want to be in commodities, stocks, commodities. And that's the only way that you can outperform that inflation rate of 7% that I've found. David Cox says, no matter if I turn my head sideways or squint, the semiconductors, SMH versus the S&P 500 is in a downtrend. Agreed. And you've got an upward facing pattern here that's broken to the downside. So this relationship, semiconductors, is going to underperform the S&P 500. You could also see the S&P 500 underperform gold and some of these other commodities. Holy macro moly. So I've not seen rail traffic data. This is ridiculously strong heading into a recession, into a slowdown, or into moderating growth ever. That's a lot of up. And what are we looking at here? So this is the rail traffic, US rail traffic in terms of increased shipping. Across the board, everything is just way up. Chemicals, coal, farm products, grain and food, forest products, grain, metallic ores and metals, motor vehicles and parts, non-metallic minerals, petroleum and petroleum, everything's up, 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 up. Everything. Look at it. It's all big, huge pluses. This is weird because this is not screaming recession. Peter Lynch says a price drop in a good stock is only a tragedy if you sell it at that price and never buy more. To me, a price drop is an opportunity to load up on bargains. I agree with that, but you got to make sure that whatever you are buying is in fact cheap, that it's undervalued. The price is under the value of the business. There are a couple of opportunities right now where we've seen big pullbacks in companies, and I'm going to, well, I have been loading up in some of those companies. Big pullbacks in energy. And energy, if you look at the oil to gold ratio, is way out there. 38 to 1, 40 to 1 at this time. Savings can be created by spending less. You can spend less if you desire less, and you will desire less if you care less about what others think of you, says Morgan Housel. I would agree, to some extent. I never really cared what other people thought, so I drive pretty crappy cars, guys. Like they're nothing special at all, and I just don't care. I do care like having fun, so I do have a couple of fun cars too because I like cars. But my daily driver, it's pretty much garbage, and it's a way to insulate myself from everyone else. The way that I do that is if I drive a crappy car and someone gives me a door ding, I just shrug my shoulders like, who cares? If it's my nice car or the cars that I really like, then I don't park next to people to get door dings. Those are my weekend cars that I have fun with. But for the most part, I don't really care. I don't wear clothes with labels on them. I try to wear clothes unless it's supporting myself, like the FV or whatever. I don't sponsor anybody else's you know brands. I'm not a walking billboard for them. Art Berman says oil companies will spend 100 billion in or on offshore projects this year. It's going to climb to 140 billion by 2027. Rigs account for 20 to 40% of development costs. Yep. And there's companies around that are going to make a lot of money. A lot of money. That's a huge 40% increase in spending in the next couple of years. And the rigs are going to make a bunch of money. A bunch. Here's Coinbase. So Coin did not close well today in light volume, and it's questionable on the weekly chart, but this monthly chart may be telling a bigger story. Could this break and be an inverted head and shoulders? It very well could be. It does look like a pretty good chart if you're breaking that downtrend. And guys, I don't have biases when I look at charts. I will tell you exactly what I think. And this looks like it wants to go higher at this current time. It'd be nice to get a stronger closing, but it is what it is. Figure out what you don't want and avoid it, and you'll get what you do want. So figure out what you don't want and avoid it, and you'll get what you do want. This Charlie. So by process of elimination, you'll get what you want. Is what he's saying in easier terms. What stage are we in right now? And these are the main stages in a bubble. Well, here's the thing: as you go into a bubble, um, that is where some areas are in a bubble. Like I think technology and financial assets are over here. I think hard assets and commodities are over here, and precious metals. So depending on what sector you're looking at, they're at different stages in this bubble. I think that crypto is in the new paradigm and delusion. I think we're up there, and everyone's just going crazy over it. I think that technology and AI is over here. I think hard assets are somewhere, depending on where you're looking at in this general area over here. You could say that we've gone through a bear trap this past however many, past year or two, depending on what sector you're looking at. And some could be maybe getting into the media attention phase. Here's a fun fact for hopefuls. Pokies, that's all it is. Crypto has so far failed to harness innovation to the benefit of society. Crypto remains largely self referential and does not finance real economic activity. It suffers from inherent shortcomings related to stability and efficiency, as well as accountability and integrity. These structural flaws result from the underlying economics of incentives rather than technological limitations. Furthermore, while DeFi and crypto, for the most part, replicate services offered by the traditional financial system, they can exacerbate known vulnerabilities. Taken together, the key takeaways from this report suggest that crypto's inherent structural flaws make it unsuitable to play a significant role in the monetary system. Bank of International Settlements is what they have. Now, does that really matter what their opinion is? I don't know. And this is what his chart is. Now, he's been inherently very bearish on this stuff. So take it for what it is. Take it for what it is. And I'm not into this stuff. Like I think it's going to be ends in a bubble at some point, and I just don't participate in stuff that's expensive. And this is look at the stick that Bitcoin is about to post this month, which is a very nice breakout. So undoubtedly, it's bullish from a chart perspective. But what everyone's going to, if you go back and you look at the greats and the people who've made money consistently over long periods of time, what they're exploiting is the difference between price and value. And that is where I get stuck. How do you value Bitcoin? And that's the problem. So is it a good price? I have no idea. No one knows, and they can't tell you. Now to Peter Lynch, he says, but only what you understand, says, buy only what you understand, believe in, and intend to stick with, even when others are chasing the next miracle, says Peter Lynch. And there's a reason I put that right underneath crypto. Buy only what you understand, believe in, and intend to stick with, even when others are chasing the next miracle. Robert Kiyosaki says, if you want to be financially free, you need to become a different person than you are today and let go of whatever has held you back in the past. And that's a tough one. A lot of people want to leave their 9 to 5, but they have no other thing to jump into. They don't know how to do it. I was in that camp too for a long time. I didn't know what to do. I just started fumbling all over the place, trying to figure something out. That was something that I did, and then I said, you know what? I should be fumbling into things that I really like and care about. The Great Marti, it says Dow Jones update metrology applied. And then guess what happens next? We're troposphere, stratosphere, mesosphere, thermosphere, and exosphere. And that's where we're at in a bubble. Obviously, he's joking, but only partially. It's not the man who has too little, but the man who craves more that is poor, says Seneca. And I think there's some truth to that. It is someone who always wants more and more and more and more, and they're just not content with what they've got. I think it depends on where you're at. That's what I'll say. Oh, look, mommy, bubbles. Meta, Nvidia, Apple, Google, Bitcoin, Costco, Microsoft, and Amazon. That's what he's saying is bubbles, and they do look like bubbles, guys. These are bubble. These are all bubble charts. And that's where I'm going to end it. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. Black Friday is still active. We do have a question and answer session coming up at 5 p.m. Sunday Mountain Time. If you guys want to join, you can interact with me directly. And we are going to go over portfolio position sizing, allocation, risk reward, setups like that, and I'll share my opinions with it. So that's what we've got for today. Catch you next time. This is Finding Value.